I bought Klarna at $20 a share a few months ago, right before earnings, and right before losing around 40% of the initial position. And interestingly enough, I actually don't know anyone who's outperformed the market with Klarna. So, how are we going to outperform the market, you might ask? Well, the tide has changed since quarter one earnings, and since that time, I've actually decided to make it the second largest position in my portfolio. So, I'll show you what I'm thinking for Klarna into the future. Now, quickly, it goes without saying, there's no guaranteed outperformance. This is just my opinions, so do all your own research before investing. Every Klarna investor should know what fair financing is, as it represents 12% of the GMV and is growing at 138% for the first quarter. And while it only makes up 4% of the actual transactions, because it's larger ticket items that are being purchased, it does make up a larger portion of the GMV. And management has been promising that as fair financing increases and as the provisions normalize, we should be seeing lifts in margins and lifts in take rates. So let's actually test this. Let's see what we could be expecting in terms of fair financing. First, we want to find the average length of each fair financing loan. So I go to the F20 to find the weighted average life, which we find is 27 days for pay later, which are buy now, pay later products, and then 109 days for fair financing. Now, a quick disclaimer, this is for 2025, and this represents the whole year of 2025, and it seems that management has been really pushing the fair financing loan in quarter three and quarter four especially. So I could actually see this figure being a little bit higher more recently for these longer term loans. But for right now, let's assume that 109 days is the length of the average weighted average life of the loan. Now, what does this mean? It means that's how long, on average, each dollar of the principal is going to last before it gets paid off. So when we do a little bit of math, we do find that the actual length in which the loan is going to be lasting is around 7 months. And just a quick note here, I think we can expect fair financing to continue to trend with the increase of merchants that are adopting fair financing. This seems to be a highly correlating idea in the past, though it must be recognized that consumers are mostly going to be shopping at the same merchants, and I highly doubt there are an extreme breadth of merchants in which merchants are going to be using fair financing options. Now, I believe that mostly consumers are going to be using fair financing with some of the bigger ticket merchants, such as Walmart or maybe even Amazon, though Affirm does have that connection right now. But I do believe into the future, that's going to be what's going to be driving fair financing. The other thing that's actually going to be pushing fair financing balances is going to be the expansion to the US. But we're actually going to get into that later because it's a really vital point that you have to understand in order to understand the business of Klarna. Now, first off, I want to see what the yield is on these loans. If we go to the interest income for 2025, we see that fair financing has 617 million in interest that is being yielded from the fair financing loans. So then when we take the balance of the fair financing loans in 2025, we do see that that's around a 16% yield. And with these longer term fair financing loans, you can expect a merchant take rate of around 1 to 2%. Klarna notoriously has lower take rates, but that's mostly because they're operating in the Euro markets primarily. As they do move to the US, you can actually be expecting a higher take rate. But let us say a merchant fee of around 1 to 2% right now. And then you see this is what we get for the overall revenue for the fair financing sector. Great, so now we have a fair financing revenue that's about 740 million. Since we have around 12 billion in fair financing loans originating in 25, we now want to find the gross profit that we can expect on these loans over the course of their life. And we can do this by finding the Affirm numbers. So Affirm actually is mostly these longer term loans. As we can see that 71% are interest-bearing loans within their book. So we can actually use this as a suggestion of what these monthly loans are going to be looking like in terms of profitability. So if we take a look, we see that the revenue less transaction costs, which are going to be alike to the transaction margin dollars of Klarna, are almost 48% of revenue. So the question is, can we start expecting this into the future for Klarna? Can we see revenue less transaction costs that are going to be higher in terms of revenue for Klarna? Well, as we focus on longer term loans, we can expect that the transaction margin dollars are going to be trending upwards, since that's the nature of the longer term loans. But if we're specifically just trying to find fair financing, let's do this. Let's say we have that 740 million about of the fair financing loans, and then let's say that we have a 40% margin. which seems much more likely in the case of Klarna since they're operating mostly in these euro places. You see around 300 million of gross profits on these loans. Now, of course, these are just assumptions, but these are ideas that we can have to see into the future for Klarna. And it's a plus that Klarna is really scaling this sector extremely fast. But these numbers clearly show why we would be wanting to use fair financing increasingly as shareholders. Because while fair financing only made up about 9% of 2025 total volumes, we actually see that it contributed, from our assumptions, 30% of the gross profit. And it also makes sense that you want to become more like an Affirm lender type business when you look at the take rate. We do the merchandise volume, which are the total volumes that Affirm is doing, and then we do the revenue. So revenue divided by the gross merchandise volume, and we see that Affirm has an 8.9% take rate, and then compare that to the 2.8% take rate that we saw for Klarna for the total of 2025. But we actually do see that that has increased since we've emphasized fair financing and since we've emphasized the US transition. And we see that fair financing actually has been working because we see the revenue take rate is 3% in Q1 2026. So this is going to be in conjunction with the US expansion. And the alike revenue less transaction costs are going to be much less for Klarna. You see that it was around 47% for Affirm, but when we look at Klarna, it's sitting around 35.5%. So while we can't say that it's going to become 47% into the future, alike to Affirm, we can say that it's likely that they're going to be trending up as we emphasize fair financing. Now let's go into the US business of Klarna. We see that the revenue has grown 67% for Klarna, while the GMV has only grown 39%. This suggests that interest revenues are finally outpacing that of the provisions. That suggests that interest is finally catching up. And we also understand why Klarna is emphasizing the US expansion. As we can see, 7.1 billion in GMV and then almost 400 million in revenue, as opposed to 26.5 billion in GMV, as opposed to the 613 in total revenue. As we can see, the take rate is almost 2.5 times higher in that of the US rather than Euro-based countries. So the idea here is that we want to emphasize the US markets, even though that there's more risk here. As you may be aware, we have more charge-offs in the US. We also have more potential profit within the US. Now, the core idea that we see that management is emphasizing is engagement. We see the average revenue per active consumer is up 10% year over year. Now, this is supported by the Klarna card and fair financing adoption. So we have to understand exactly why management is trying to do this. As people use more products within Klarna, they're going to be producing more revenue for the business. And it's extremely important to make sure that you're getting bank account users, because Klarna actually does have a moat in the aspect that they really are a bank, unlike a lot of other fintech lenders who are just a face of a bank. Klarna actually is a bank. And finally, we see the reason why Klarna is emphasizing the card is because it's really integrating US consumers. We have a large growth in the US consumers that are using the card. So it shows that Klarna is really emphasizing making sure that we have the Klarna card for everyone in the US. It's just going to mean deeper integrated consumers that are in the US market, meaning a more profitable market, allowing us to make more money. That's the reason why Klarna still seems to be supporting the idea of debit transactions. It appears that this is more of an engagement idea rather than an actual money-making method. And the last idea that I want to emphasize are subscriptions. I believe these are one of the largest moats that you can possibly have in fintech right now. And I've been a shareholder for a little bit of Sezzle, and I believe this is what's led to the outperformance of Sezzle over the last few months on the market. If we take a look at the subscriptions, when you get a subscription, it only makes sense that you want to use the card more. When you use the card more, it's going to become top of wallet. And when it becomes top of wallet, you're going to be more integrated into the ecosystem, and you're going to be using Klarna products more often. So overall, it's going to be a much more profitable venture for Klarna. And as we can see, membership revenues are up 578% year over year. We aren't shown the actual balance of membership revenues, but even if these are lower, it shows that people are becoming more integrated into the environment of Klarna. And I believe that's exactly what we need to happen in order for Klarna to have outperformance in the market into the long term. And I do believe that Klarna does have what it takes to have outperformance against the market for the long term. Thank you for watching.